Good morning, everybody. This is Live Trading Talk with Patrick MontesDeOca for January the 14th, 2022. We have some economic news that came out. U.S. retail sales sink 1.9% as Omicron, high prices, and shortages trigger the biggest drop in 10 months. The number sales at U.S. retailers such as Target and Amazon sank 1.9% in December. This is the biggest drop in 10 months as the Omicron variant of coronavirus spread like wildfire and shoppers confronted higher prices and shortages of some popular products. Economists polled by the Wall Street Journal had forecast a 0.1% decline in December retail sales. The figures are seasonally adjusted. If high inflation is taken into account, retail sales were even more depressed than December. Retail sales are a big part of consumer spending and offer cues on the strength of the U.S. economy. Sales rose sharply through most of last year before tapering off in the waning months of 2021, suggesting the fourth quarter economic growth won't be quite as strong as expected. The big picture, the economy suffered a letdown toward the end of 2021 because of Omicron. Now, what I want to do is put into perspective here the fact that the best cure for higher prices is higher prices. And we're beginning to see that reflected on this report, that we are beginning to see consumer resistance to higher prices. Now, this has been compared to levels of inflation that essentially registered the biggest gains since 1982. Now, one of the things that I want to put into perspective here is the difference of inflation in 1982 and the difference in inflation at the present time. And this article of the Wall Street Journal explains, I think, pretty much the complexity of that paradigm, you might say, that is different than the inflation that we had back in 1982. This report was written by Greg IP on January the 12th, 2022 for the Wall Street Journal. Consumer price inflation in December at 7% was last this high in the summer of 1982. That's about all the two periods have in common. Today, the inflation rate is on the rise. Back then, it was falling. It had peaked at 14.8% in 1980, while Jimmy Carter was still president and the Iranian Revolution had pushed up oil prices. Core inflation that year reached 13.6%. Upon becoming Federal Reserve Chairman in 1979, Paul Volcker set out to crush inflation. With tight monetary policy in combination with credit controls, that effort pushed the U.S. into a brief recession in 1980. Then, as the Fed benchmark interest rates reached 19% in 1981, a much deeper recession begun. By the summer of 1982, inflation and interest rates were both falling sharply, and 4 decades of generally low single-digit inflation would follow. We have had a dramatic success in getting inflation rates down, one Fed officials observed that August. But Mr. Volcker had other problems to contend with. His high interest rates had pushed Mexico into default, touching off Latin American debt crisis, and unemployment would climb to a post-World War II high of 10.8 that fall. Now, as a consequence of this high interest rate environment, the Mexican government defaulted on its loan, and it essentially devalued its currency by 16 pesos to the dollar, literally overnight, to 46 pesos, and then it went to the 1,000, and inflation and hyperinflation was rampant in Mexico from that point on. If we can use this as a lesson in terms of what interest rates potentially can do in an environment such as the current one, that we have a debt bubble which is close to $30 trillion, and we have essentially created money out of thin air, which is essentially about 13-14% of GDP. These are the approximate numbers that we're dealing with. So, with the Federal Reserve commenting on the possibility that rates are going to increase, I believe is a false sense of security that is creating potentially a serious correction in the market. And we have yet to see the first increase of interest rates, what they are going to do when the Feds decide to raise the Fed funds benchmark rate and see how the markets react. I believe that we're looking at a different environment in terms of inflation. Back in 1982, the price of gold reached about $900 as inflation soared to 19%. In 1982, the price of gold collapsed down to a couple of $100 until 2000, around 2000, where we began to see the bull market in gold ignite. So I believe what we're looking at is a potential increase in the inflation rate as opposed to a decline. And this is going to put a tremendous amount of pressure on the Feds to raise interest rates without collapsing the market. The markets already have discounted 4 interest rate hikes in 2022, just based on the talk of the Feds raising interest rates. And the market already corrected. Since June, we've seen a decline on commodities, metals, digital assets, and it's all been done on pure rhetoric. So we're coming down to the reality that interest rates cannot go up in this environment as we begin to see a tremendous decline of consumer demand, as opposed to what was being sold to us, that the economy is exploding in demand and people are coming. People are not coming back to this economy. People are afraid to come back 100% due to the Omicron. Things have changed. And so we're not into this explosive economic growth, and we're going to begin to see, I believe, as the year unfolds, a slowdown in the economy, which is going to put more pressure on the Feds to do more rhetoric, more talk about raising interest rates. And I think the market is going to realize that it's all talk, and we can potentially see an explosion in precious metals, in risk assets, in digital currencies, as already they have been discounting 4% increase. 4 times, I should say, a rate rise, a rate increase. And if we come back to the gold market here, after analyzing these fundamentals here that are completely, I believe, inversed to what the market is in terms of price, and the scenario that is building up here is truly, truly explosive for precious metals. There's no other way that I can say that without sounding like a cheap car salesman. The fact of the matter is that the economic indicators are different. Inflation is not going to be going down. Inflation is going to remain permanent. And this bottleneck issue, however it's going to be resolved, will be the dictating factor, basically, in terms of the demand coming back into the economy. But if we are beginning to feel the sentiment that things are going to get more expensive, that the cost of money is going to get more expensive, then we're looking at a different change in paradigm economically, and the values that are being recalibrated could be permanent. So I don't expect at this point in time inflation to retreat, to come down. In fact, I think we're going to consolidate here possibly, and we're going to begin to see inflation heat up as we begin to see more supply shortages unfold, and it's going to put price pressure on some of these undervalued assets that we have, for example, like the silver market. The silver market is the most oversold commodity on the board, particularly in relation to the economic news that we have about inflation, not to mention the industrial demand that potentially is going to be, what I believe, explosive in the application of solar panels and technology. And so I am looking at silver potentially as an explosive entity, as an explosive product coming out of this price suppression like a pressure cooker. Now, the futures contract in silver is one of the markets that you can trade. But we're going to focus on a particular stock that I believe is going to make a phenomenal move, and we're focusing basically on this stock for the immediate future. We'll be right back. The product that we're looking at is Hecla. Hecla Mining. This is, I believe, potentially an explosive stock. And we have been recommending our traders in our private trading room here in Discord to build a position in Hecla. Hecla produces nearly half of the U.S. silver. With operating North American mines, a number of exploration properties and development projects, a natural revenue hedge through the production of both precious and base metals, and its status as a growing gold producer, Hecla Mining Company is the largest primary silver producer in the U.S. and the oldest New York Stock Exchange listed precious metals mining company in North America. I'm going to recommend to buy and hold Hecla. You can put it in your IRA account. You can put it in your trading account. You can buy it dollars per share. And I would suggest not to margin, not to use leverage, but simply to buy the stock initially. The stock has come down into a Fibonacci correction here that indicates about a 60% Fibonacci retracement from the move that we saw since March of 2020, when the price made a low of $1.40. And we saw a rally to 679 by August. We corrected into October of 2020, and then we rallied from that 448 level all the way up to about 944, which was the high that we made on May 31st of 21. Now, we've been in this corrective pattern here. We just come down to these levels of about 454 that go back to October of last year. And our indicators are showing that the correction potentially has been completed. And we're looking at about a 38.2% correction using Fibonacci arcs in combination with Fibonacci fend lines and Fibonacci retracements. This is a long-term play that I believe you want to buy and hold. The company has derivatives, options that you can use, leaps that you can buy to build a position. But we are strongly recommending Hecla as a buy and hold. And I believe we're looking at least a test of the 78.6% Fibonacci retracement. That brings us back up to about 829. So from current levels, there is a possibility that you can almost double, potentially. And it is a great opportunity to load up if you want to trade in silver as a silver stock. We're also looking at SILJ, which is basically the Silver Junior Silver Miners Trust. And if we take a look at the chart here, this is the weekly data. It has come down to the blue levels that I point out, which essentially confirm that this is accumulation time. These levels here are telling you to accumulate supply, build up inventories, and SILJ. So we're recommending Hecla as a stock, as a silver mining stock. It's one of the largest producers in the United States. And the ETF SILJ as a buy and hold for the rest of the year. Let's take a look at Bitcoin. And we seem to be once again building, consolidating in this level here, between the daily average and the weekly average. The daily average today was 43,160. And you can see the market reverting from the buy one level daily here today of 41,870, and it has completed the target of 43,160 as we speak. So this is a great instrument if you want to scalp Bitcoin and use it as a GPS for your trading. So what I've shown you here is basically how I'm interpreting the economic news that are coming out myself into basically a position that I want to monetize. And because the fundamentals are so inverted to the markets here in terms of particularly this undervalued levels here, I believe that this is a tremendous opportunity to buy the market as we will adjust, as I said, if in fact we do not see 4 interest rates hikes in 2022. Have a great weekend, everybody. Be safe. Take care, and I will talk to you next time.